Fitch Rating affirmed Uzbekistan's long-term foreign currency credit rating at BB with a stable outlook. According to the report, Uzbekistan's economic growth will slow to 5.5% in 2026. More specific on these details in the following report.
The rating is supported by low government debt, significant fiscal and external reserves, GDP growth and economic reforms. These factors offset challenges like low GDP per capita, poor governance, high commodity dependence, dollarization and a large state presence in the economy. In the first half of the year, the fiscal deficit increased by 0.1% of GDP. Fitch forecasts a deficit of 4.2% of GDP for the year, which is below the 2023 level but above the target. By 2025, the state budget deficit will narrow to 3.4% of GDP due to higher energy tariffs. In 2026, the deficit is expected to be around 3%, slightly higher than other countries, with BB- credit rating. Last year, the government debt to GDP ratio rose by 2% to 32.5%. Government debt is expected to remain stable and decrease to 32.1% by the end of 2026, which are almost twice as good as similar countries. Uzbekistan's economic growth is expected to slow to 5.5% in 2026 due to fiscal consolidation and lower investment, which will offset the impact of slower inflation. High dependence on trade with Russia, especially due to gas supply contract with Gazprom, is a risk. However, Fitch notes Uzbekistan's commitment to comply with sanctions. The current account deficit has narrowed to 6.2% of GDP this year, thanks to the 32% increase in remittances over 7 months. Foreign direct investment, mainly in the energy sector, will increase to 2.5% of GDP, while external reserves will continue to shrink. The acceleration of inflation in May is due to higher energy tariffs, but there was a significant slowdown in core inflation. Inflation is projected to be 9.5% in 2024, 8% in 2025, and 5.8% in 2026. After the first cut in the central bank's key rate since March 2023, Fitch expects further easing of monetary policy as inflation slows.